Welcome to today's edition of the Exploring Mining podcast, featuring stock news from TSX, TSXV, CSE, ASX, NASDAQ, and New York Stock Exchange mining companies, plus interviews with CEOs and leading experts.
Welcome to a special edition of the Exploring Mining podcast at Investor Ideas, featuring an exclusive interview with silver expert Peter Krauth. Peter is the author of the best-selling book, The Great Silver Bull. Peter is a frequent panel speaker on silver at many mining events around the world and an expert in the precious metals market. He runs the silver-focused investment newsletter, Silver Stock Investor. Peter has researched, written, and invested in silver for more than 20 years, using his extensive industry network to uncover outstanding opportunities. He, also with his colleague Gwen Preston, this year launched Evergreen Investing newsletter focusing on the opportunities in the green energy market transition. You can learn more about both newsletters at InvestorIdeas.com and evergreeninvesting.ca. In this episode, we talk about the effects of interest rates, inflation, and how gold-making moves give silver the opportunity to break out. Peter gives insight into the demand for silver for the solar sector and how mining will play a large part in the energy transition. We also discuss the juniors market, including a few of our favorites, including Suma Silver, Hercules Silver, and a few others. Peter, thanks for joining us on our show again. When we talked earlier this year, we had maybe a little bit more positive outlook for silver. The prices have dipped so far this year with rising interest rates. We've seen prices pick up lately in the last couple of weeks with geopolitical tensions and increased hope that the Fed will not increase rates going ahead. You want to just give us a little bit of a recap of the year so far and maybe what you see for what we might be in store for November?
Yeah, absolutely. So thanks for having me, Callie, and I'll be glad to give you my overview. So for me, at least, it's all about inflation and the interest rates. I think that's really kind of the main theme that's driving everything right now. And I say that because, of course, everybody, and I think rightly so, looks at the U.S. as, you know, the determining market for most. And almost the entire U.S. Treasury yield curve is above 5%. The only exceptions right now are the I think the 10-year and the 30. So what that means to me is that the market's really expecting inflation to stay elevated, and it wants to be rewarded for lending. So, and that's even to the lowest risk lenders. So you could argue that lending to the U.S. Treasury is the absolute lowest risk possible. And yet people still want 5% or in that 5% range. So to me, that says that long-term yields are going to stay high, and there will be a considerable headwind as well for businesses, for mortgage loans, car loans, anything beyond that. So, and if you look at headline inflation, we're still at about 3.7% in the U.S. The Fed follows something called Personal Consumption Expenditure Index. That's also close to about 3.7%. So these two main inflation indices are clearly nearly double what the Fed wants as its target, which is 2%. We've got a lot of work to do to try and get inflation back down. And I think that these high bond yields are actually doing some of the Fed's work. That's probably one of the big reasons that they did not hike in November. And so to me, at least, the jury is still out for what we should expect in December from the Fed. But what is really encouraging is to see how gold has been so resilient in this kind of environment. For interest rates to be up around 5% and inflation to remain high like this, but especially interest rates, because it's always a question of a trade-off. People have to choose what investment they're going to put their money into. And if you look at bonds that are paying 5%, as I say, essentially risk-free, people will look at that and say, well, why should I invest in stocks? Why should I invest in tech stocks in particular? Why should I invest in gold? And so gold, for example, is still very close to the $2,000 mark, and with all these headwinds of high bond yields. So to me, that tells me that the precious metals market really do see a strong potential for a recession to start probably within the next quarter, perhaps at most, perhaps 2 quarters. The precious metals are really sniffing that out and saying that you want to be at least partially invested there as well.
As far as gold, it's definitely been setting records, and yes, there's been some strange how things have worked this year is not how we're used to seeing things. As far as the technicals go for silver, we kind of see that we're in the range of that 2250 to 2360, 2370 range. Do you think if geopolitical tensions keep rising, or if rates don't change for the next month, do you think we'll see a breakout from there, or how do you see that playing out?
Yeah, I mean, I really do think that silver is going to follow gold. If we see gold break through, say, 2050 or 2100, ideally, kind of hold that and then likely at some, go beyond that 2100 level, I think we're going to really start to see silver kick in a big way and start to play catch up. If you look at the gold-silver ratio, we're still high 80s. That's historically quite high. And when you see that ratio drop back below 80, what that means is that silver is starting to catch up on the gold price relatively. And typically when that happens, both metals start to do very well. So I think silver will take its cue from gold. We're going to have to watch and wait for that breakout in gold to finally happen. And that's when I think it's going to kind of be time to double down on silver.
So right now, we all have our fingers crossed and toes crossed, rates to stabilize. Yes. Can you kind of give us a little bit of a rundown of the 3 scenarios, if it stays at this level, if it goes back up, or if we actually see it go down, what you think, we'll see it play out over the next couple of months?
Here's what I expect for interest rates. With nearly the entire yield curve recently at or above 5%, I'm not surprised that we're seeing bond buying. People are, it had basically gone a little bit too far. So yields have come off a little bit, especially on the longer end. And but I don't expect that to last. If you figure 5%, we'll take 5% as essentially what bonds are paying right now. That feels high, but I think that we're, rates have been so low for so long. We're talking 15 years, 18 years nearly since the financial crisis. This is artificial, abnormally low. And so 5% is much, much closer to normal. In fact, probably typically on average, relatively below normal in terms of especially longer yields. So, I mean, these rates should probably be closer to 7%, 8%. So that's what I see happening. I do see that we're going to have a lull. Perhaps it'll last for a few months where, these yields will have come back down a little bit. They may continue to come back down for a little while longer. But then I think that the greater trend is going to resume, and we're going to see rates start to pick up again. So bonds will sell off. The yields will pick up. It's true that that's going to be somewhat of a headwind for gold. However, there is also the balancing or the opposite side of that, which is that helps do the Fed's work with yields high. They don't need to raise rates that much because that puts pressure on the economy. It slows business down somewhat. It is likely to help raise unemployment a little bit. It's just too hot as far as they're concerned. And so I actually think that the precious metals can do quite well in that environment, because what it's going to do is it's going to reinforce the fact that the Fed has little to no room to continue raising rates. So we're getting, I think, really close to that point where the Fed does not necessarily pivot downwards, but we see a clear message from them that they're done raising rates. And I think that will be very, very bullish for the precious metals.
Oh, I like that answer.
A bit long-winded, but hopefully I got my point.
I like it. So last year we already saw a record high deficit for silver, and we're expected to post another sizable deficit this year.
Right.
What does that mean for the silver market in general? How do you see that working out for juniors? Do you see that we're going to fill some of that gap?
Yeah, so I don't see, honestly, the only way that I can see, and very realistically, some of that gap can be filled from above ground existing inventories and stockpiles, but that can only go on for so long. And of course, you know, as the silver price rises, both people who own silver, whether it's silverware, jewelry, whatever it may be, they will bring it to the market and they will cash it in, and that will help sort of temper at least somewhat. It'll temper a little bit a rise in silver prices on the back of really strong demand. But I really only think that can last for so long. You know, we've swung in the last 3 years. We've swung from a 50 million ounce surplus to a 237 million ounce deficit last year. That's over 300 million ounces of swing in 3 years. The forecast for this year is about 140 million ounces. The Silver Institute is going to revise that in about 8 days or so, I think, is what we're expecting. They're going to have, in November each year, they put out revised estimates. I think they're going to probably up that to closer to 160. And I think by the time, you know, 2023 is behind us and we're able to look back at the full year's numbers, we're probably going to be closer to 170 or 180 million ounces of silver deficit. So as I say, stockpiles can feed some of that deficit for a while. It can only go on for so long. The mining companies, the silver miners, are struggling to find. There are almost no sizable silver deposits out there. They're taking harder to find. They're taking longer to get approved and to come online. Economic deposits, permitting, and geopolitics are always getting in the way. And so I think that the supply side is going to remain very challenged. And so silver should do very well over the next several years. As I say, it's going to follow gold's cue. It may not break out tomorrow, but it has proven itself over decades to perform very, very well in precious metals bull markets. I'm not expecting that to be any different this time. In fact, I think we could see outperformance from historical performance in this bull.
Mexico and Peru, obviously, two of the biggest headaches this year.
Yep.
Two of the biggest producers.
Absolutely. That's for sure.
Do you think that will kind of balance itself out, or do you think investors should be looking for different areas of play?
So what I would say is that, you know, there are some names that of existing producers that have been around for quite some time that are actually also growing quite aggressively. They may be, in some cases, in some places where geopolitically it's sort of okay, not especially conducive or friendly, let's say, lately to mining. I'm going to give Mexico as an example because the existing president basically has banned new open pits for mining. But, you know, if you're looking at an existing miner that has a project that's permitted, that will have zero impact. And in fact, you could look at that and say, well, perhaps that company deserves a bit of a premium because they've got something that may be more difficult to get in the future. So these are the kinds of things that I would look for. There are companies that are established, that have been running for a decade or longer. As I say, they're growing quite quickly, adding a lot of ounces of production every year, finding a lot more silver, in fact, every year, and have an easier time, you know, growing that production because, as I say, it could be growing production at an existing mine that's fully permitted. And the key is going to be for them to try to keep their costs under control. Inflation is hitting them like it's hitting everyone. So if they can manage to keep their costs under control and benefit from a rising silver price, they're going to do very well because the leverage is just going to be tremendous to their bottom line.
As we just talked about the deficit, let's talk about one of the biggest demands for silver is solar. So we spoke quite a bit about this last time. But for listeners that are new to the story, let's just quickly go over the demand and how much is needed in the solar market and what's been happening this year. I know there's some new technologies for solar that are increasing the demand, and obviously the green energy push is massive as well.
Absolutely. So, in fact, I was just looking at some statistics this morning, and if you go back to, say, 2014, solar demand for silver represented about 5% of overall silver demand, and by currently it's at about 14%. It's expected to grow by 169% between now and 2030. That's according to Bloomberg NEF projections. And so it could represent as much as 20% of the entire supply of silver every year that would go potentially within just 7 years to the solar market. It's just incredible, the kind of growth in silver requirements for solar. And as you said, technology is a very big part of that. There's a consultancy out of Norway called Rystad, and they do some great work. They looked at the three technologies. So you have PERC, HJT, and TOPCon. PERC is the current sort of dominant technology. Then you have HJT and TOPCon that are these newer technologies that are really taking over, so to speak. Now, just 3 years ago, they represented about 10% of manufacturing capacity in the solar sector. This year, they're expected to already represent 35% of manufacturing capacity. So what that means is, well, why that's significant is because these two newer technologies for solar panels actually require anywhere from 50 to 150% more silver per solar panel. So, if you're listening to this and you're asking yourself, well, why would somebody produce a solar panel that requires more silver? And it's all economics. The fact is that, yes, it takes more silver, and yes, it costs more to produce that panel, but the energy output is significantly higher. And so therefore, it more than justifies the higher cost to produce that panel. So that's massive growth that we see coming, as I say, in demand already from solar itself, but then in the newer technologies that are really actually becoming dominant in the solar industry. So it's almost like you've got this accelerating demand in solar for silver. In fact, Rystad, I had gone back to them and emailed them a couple of questions that I wanted to understand a bit better in their research. And they came back to me and they said, the only input or the only resource where they have some concern in terms of producing solar panels is silver. None of the other inputs are of any concern to them, but they see a high risk of potential shortages of silver for solar just because the demand is just growing so quickly.
Do you think that, I don't know if I've never seen so far, but do you think that some of these solar companies are, obviously as they're growing and they need silver demand, that they're going to start investing in silver producers? I think it's a great idea if someone does it eventually. Have you heard of anything like that there's actually becoming a relationship between the two?
That's very interesting. I've thought about that as well. And I think if I remember right, I may have actually written that it would not be surprising to me that we would see that sort of thing happen. That's great insight, actually, Callie. I think that would make a lot of sense, especially given the high risk for shortages. I haven't seen that kind of news yet. The closest I've seen is, and it's not for silver specifically, but it has been, let's say, some of the really large automobile manufacturers, the conglomerates. One name that comes to mind is Stellantis, and they produce a whole range of brands of cars, and they are becoming quickly more and more vertically integrated. They're buying, they're actually investing directly in mining companies that produce copper, lithium, nickel, all these inputs, because they're going to require that for batteries. So, for an EV manufacturer, but definitely more so for a solar panel manufacturer to invest in a silver producer and lock up a chunk of their offtake that would be fantastic and very smart. And it would certainly not surprise me to see that coming. It would make a lot of sense, frankly.
Well, if it happens, then they heard it here first.
Well said, exactly.
So I wanted to kind of just get a little bit into the juniors market. This week, Barrick increased their stake in Hercules Silver with about 10% now investment in them. Is there any juniors that you super like the story out there? I obviously love Silvercrest. That was one of my first clients that I ever worked with, so they're my personal favorite, but is there any that you want to share with our audience as well?
So I have to agree, Silvercrest is a great one. Just very quickly, that's out of Mexico, very high grades in production, and that's just a silver. That's a silver machine, really, and so high grades and high margins. But if you look at, so you mentioned Hercules. I'm happy to say that my subscribers are up over nearly 600% in Hercules.
Oh, well done.
That's a very big win for us. I think it's got a long way to go, even from where it is. We've taken partial profits already, just because I thought it was, wise to do that. But if I look at the biggest potential in juniors, one of the sort of my highest conviction names is Suma Silver. Now they've got two what I consider flagship projects, which is not typical, but they're both so high potential, and they both got serious scale and great histories. The first one is the Hughes project, which is in Tonopah, Nevada. And so if any of your listeners know BlackRock Silver, which recently increased its resource to over 100 million ounces of silver equivalent and very high grade, Suma's project, Hughes, is actually across the highway, literally across the highway. It's sort of the eastern half of that BlackRock deposit. So I'm very bullish on that. They've been drilling that out. We're going to we've been getting some great results on that already. And then their second, what I consider flagship, is in New Mexico, and that's called the Mogollon project. That's a historic, or there are several historic mines there. Again, very high grades, lots of underground workings. It's actually something which the company's CEO, Galen McNamara, has said that they think that this may actually be the one of the very best remaining silver vein fields left in the U.S. And so, it would not surprise me that very realistically between these two projects, they could ultimately at some point, and not that far off, maybe within a year or two, prove up about 100 million ounces, maybe somehow split evenly between those two projects. And I think there's plenty of room because they've barely explored on both of those projects, somewhere around 5 to 10% of the land packages that they have. I know that's the case in New Mexico at Mogollon. And if you look at, for example, back to Hughes for a moment, they've done these very, very wide step outs, multi-kilometer step outs, and they're getting multi-meters of hundreds of ounces of silver per meter grades. So they know that there is plenty of silver left, and even though they go far from where the historic mines are, they're finding plenty of silver. And so I think that this is going to take some time, but I believe it's one of the sort of most undervalued and sort of highest conviction names, at least for me, in my list. And another one that I really like a lot is Sierra Madre. Now, that's a company that has bought a mine from First Majestic. And so Greg Liller, who is the chief operating officer at Sierra Madre, he used to actually run with another colleague of his at Sierra. He used to run that mine for First Majestic. So he knows it inside out. They have all sorts of historical data in terms of costs for utilities, costs for fuel, grades, you name it, haulage, everything. So they're in the process of bringing this mine back online. In fact, they can do it, I'm going to say really in short order, relatively short order. One of the great aspects of it is that there is a large underground resource in the mine all they need to do is actually, I believe it was backfill, but it's high grade enough that they can actually just haul that ore out and then process it. They don't even need to physically mine it out. So that would be a great way for them to get started, start cash flowing. And they think too that they've got potentially one of the largest undeveloped vein fields in Mexico. So a lot of blue sky potential with them at Sierra Madre. I'd have to say those are two of my favorite names right now that the market really has yet to catch on to. I think that your listeners would do well to look at those very closely.
Just to kind of recap on silver, and then we'll move a little more into the green energy transition. If gold keeps moving as it does in the S&P and everything is breaking out and keeps, above average, do you think we'll see the silver prices around the 26 in the next 6 months if everything keeps going the way it does, or are you going to kind of see resistance still around that 23, 24 range?
I think that 26 is, that's essentially, if we were at 23 very, very recently, that's $3 from there. And I think that if we're looking at maybe not 6 months, but if we look at, let's say, by the end of the second quarter, so let's say about 8 months, I would not be surprised to see silver reach that kind of level. I do think we're going to see a breakout in gold well before that. And so that's one of the big reasons I think that silver could reach those kinds of level. You were suggesting, we could sort of talk a little bit about green energy and the energy transition, but here's a great sort of segue, I think, to that, is that there was this meta-analysis done. I think it was the International Energy Forum that put this together. They looked at something like 11 studies, global studies, and then they took the median of those studies. And and this was for requirements for different metals, actually, for the energy transition. But if you look at silver specifically in terms of what they found, is that the requirement for silver by 2030 is going to be essentially double what it was in 2020. And by 2040, it'll be triple the level that it was in 2020. So this whole energy transition is going to require an incredible amount of silver. I think that it's really one of the sort of the highest conviction ways to actually play, potential gains and profits on an energy transition. A lot of people are looking for the technology plays and so on, but a lot of resources and other kinds of inputs have to go into making this happen. A lot of it is, of course, mandated. So even if we get slowdowns in the economy, it's going to happen. And because it's mandated and it's going to happen, the resources have to come from somewhere. So, a lot of people, especially, I think maybe some of the younger generation, have this sort of this big X on mining. They think that it's not environmentally friendly. I think that they would actually do well to look into the best practices, especially in the West, in terms of what mining is like these days. Companies have become very, very serious and very environmentally responsible in terms of how they extract and leave things when they're done mining. This will not happen without mining. It's that simple. And mining, because it's so crucial to the transition, I think that's sort of one of the biggest no-brainer ways to actually play the transition.
So as we move a little bit from silver and wrap that up, I just want to quickly talk about your evergreen investing newsletter that you have with Gwen. When I interviewed her a couple of weeks ago, she briefly mentioned some of the things that you guys talk about, and I'd love to hear what you cover in the newsletter as well. And for the people that are listening that are interested in the green energy push, I definitely think it's a good newsletter to check out.
Great. Well, yeah, thanks for that. It's called Evergreen Investing. You can go to evergreeninvesting.ca to see more and know more about that letter. It's really geared towards a little bit of a younger audience. I'd say probably anywhere from about 25 onwards. And so this is definitely a lower risk type of research newsletter in the green area, the green transition area. I cover the three arenas that I cover are agri-food, sustainable transportation and infrastructure, as well as recycling and waste management. And so what we do is we look at these areas and we look at low-risk ways to play these areas. And that could be anything from a broad-based ETF, an exchange-traded fund, which is, just for your listeners' knowledge, in case they're not familiar, that's essentially like a fund. It's a stock, but it's like a fund that owns a bunch of different companies that are in that particular sector. So an agri-food stock, for example, or ETF, for example, might own fertilizer companies. It might own large equipment manufacturers like John Deere that make farming equipment. It might own water filtration companies, all sorts of things in that space. So naturally, by buying an ETF, which is instantly diversified, your risk is lower. And a lot of these are larger capitalization companies, so they themselves are more mature. They may maybe already pay a dividend, and so they're certainly typically lower risk. And we're slowly, as the newsletter evolves, we're slowly bringing in other names, so more individual names, but again, large cap companies typically, like in the agri-food space recently, I recommended one of the world's largest fertilizer producers. And now, if we can get into the weeds a little bit, pardon the pun, that wasn't not even intentional, but if you look at fertilizer companies, typically they are very, very, very big consumers of natural gas. Now, at least as far as carbon emitters go or carbon fuels go, natural gas is one of the cleaner ones. So there's that already. And they use it in a big way to produce things like ammonia, which is then converted to produce different kinds of ultimate fertilizers. But a company like the one that I had recommended, they are very, very aggressively investing in technology and using renewable sources of energy because it's very energy intensive to produce ammonia and ammonia-derived products. So that's why they use the natural gas. And yet they're finding ways to use renewable energy to be able to produce these products. They're, despite, as I say, some of these larger companies that are big consumers of typically, carbon intense fuels, they are determined themselves to minimize and ultimately reach a point where they're completely carbon neutral. These are the kinds of things that we look for in recommendation to meet the overall intentions of the newsletter. So, between the areas that I look at and the areas that Gwen look at, there are 6 in total. She looks at energy metals, energy technologies, and the whole carbon credit space. And so I think that we really look at this, the entire green transition sector, quite broadly. I think that we do cover it quite well. And essentially, it's not about ESG, which is environmental, social, and governance. That's very, very, very broad. What we really do is focus in on the inputs and the innovations that go into successful companies in the energy transition space or the green transition space. Yeah, we launched that at the start of this year, and it's going well. We get great feedback from people, from our subscribers, and we think that it's a great way to we've got a lot of experience in researching and writing about these areas. We try to keep this accessible in terms of the language we use and the approach that we take to not get too technical on things. But I think that it does make for a good, entertaining read every month. And I think it makes a great introduction to this whole area.
Saw you at the Metals Forum. You said that your audio is coming out for your book. So for listeners, where can they get that? Where can they get the original? Tell us about your newsletter.
Yeah, well, thanks for that. So the book is available on Amazon. You can go to Amazon and just do a search for The Great Silver Bull. Right there, you'll see 3 options: the paperback, the Kindle version, and the audiobook version. I wanted to mention, just in case, I know the odds are not that high, but a couple of months ago, it actually came out in German. So a company in Germany approached me and asked if I was willing to have them translate and publish the book in German. So that's something that's been available for the last few months. If anyone is interested for any reason in that version, they can just search KOPP, KOPP, Verlag, VERLAG, and then Silver. I'm sure that from there they'll find the book. So I spend most of my time between my newsletter, Silver Stock Investor. So if anybody wants to see and know more about that, they can go to InvestorIdeas.com. As well, I spend a fair bit of time on the other newsletter, Evergreen Investing. So if anyone listening wants to know more about that, it's evergreeninvesting.ca. And so all of this is under the banner of Resource Maven, which was launched by my colleague Gwen Preston about 8 years ago or so. So that keeps us very busy, and I think that a great range of research for people to sink their teeth into, and we do a lot of really hard work to
well, that does it for today's Exploring Mining podcast. If you'd like to be a guest or sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.
Sharing one of the days. This is a conference of mostly junior mining companies that are going there to present to investors. So I'll be chairing one day of mining company presentations. So that's at the end of November. After that, in January, I'm going to be at the Metals Investor Forum at the end of January, and that's back-to-back with the Vancouver Resource Investment Conference. I will be there as well, presenting at both of those. And then from there, we have PDAC, as you mentioned. There's also the March. This is in Toronto. You've got the March Metals Investor Forum that takes place the 2 days prior to PDAC in Toronto, followed by PDAC itself. So that's like 5 events in the next sort of 4 months or 5 months or so. So that'll keep me quite busy, and I'd certainly be happy to talk to anybody who's interested, who makes their way out to those events. The main ones would be, now X, previously Twitter. That would be Peter_Krauth and Krauth. And then you can find me as well on LinkedIn at Peter Krauth. So those are the easiest ways to follow my postings and to reach out.
Thank you so much for the interview, Peter. It's always a pleasure having you on the show.
It's been a great time for me too, Callie, and I certainly look forward to doing this again soon.